China's economic growth slowed to its lowest level in nearly 30 years in the second quarter of this year. Donald Trump claims that this shows his trade war policies are hurting Beijing. But in reality, the situation is far more complicated. China's gross domestic product slowed down to 6.2% in the second quarter, down from 6.6% in all of last year, is not primarily the result of the trade war. Of course, the tit-for-tat tariffs have hit trade. China's exports to the US fell 7.8% in June, and US exports to China slumped 31%. But such numbers, although stark, have little impact on the broader Chinese economy. In truth, net exports contribute less than 1% of China's total GDP. China's slowdown has been created overwhelmingly by domestic drivers that have little to do with US policy. The main drags on Chinese dynamism come from weakening investment in infrastructure, slowing industrial output, and a decline in the construction of new houses. All of these weaknesses derive from domestic sources rather than from the trade war. And in any case, China remains by far the world's most vibrant economy. Even growing at its lowest level in 30 years, it is still on track this year to add more than 1.4 trillion US dollars in value. That, for context, is bigger than the entire Australian economy.